Good afternoon and welcome to the 25th EBI Policy Series. I'm your host, Nate Smollett, and today we will focus on the climate litigation risk. A quick word why we were keen on organizing today's webinar. Climate litigation risk has become increasingly important from a bank's perspective due to the rapid rise in climate-related lawsuits and probes over the past few years. Some sources indicate a 12-fold increase in climate-related litigation across the globe and against banks between 2020 and 2023. This surge in legal challenges poses significant financial and reputational risks for banks, and particularly those with misaligned credit portfolios or unfulfilled climate commitments. Banks face scrutiny over their role in financing carbon-intensive sectors, implementation of environmental policies, and progress on transition plans. As regulatory frameworks evolve and public awareness grows, banks that fail to adequately address climate risks or deliver on their sustainability pledges may find themselves vulnerable to lawsuits from non-governmental organizations, clients, investors, and shareholders. This emerging risk landscape necessitates that banks develop robust climate risk management strategies and Paris-aligned transition plans to mitigate potential legal and reputational damage. Now, at the EBI, we were fortunate to have drawn the interest of a distinguished panel to carry us through all this to a greater extent in the next hour. So before I introduce today's speakers, who will definitely shed more light on this topic, let me quickly provide the format of our webinar. The webinar is planned for an hour. The panelists shall steer us through the discussion on climate litigation risk for the first 45 minutes of the webinar. And that should leave us with sufficient time for a Q&A discussion. And in this part, the audience is also welcome to pose a question in the chat tool option, which I will then include in the discussion. Now on to the panelists' presentation. I would first like to introduce Marguerite O'Connell. Marguerite is Senior Legal Counsel in the European Central Bank's Financial Law Division. There, she advises on EU financial services regulation, sustainable finance, and economic governance. She's also secretary to the Network for Greening the Financial Systems Experts Network on Legal Issues, and she will provide an overview of the trends observed in respect of climate litigation and how these trends can impact the financial sector. Next, we have David Ramos Munoz. David is professor of commercial law at Universidad Carlos III de Madrid, where he co-founded its Climate Strategic Initiative, and he leads several research projects related to climate change and sustainable finance. He is a member of the academic board of the EBI, where he leads the working group on finance, climate change, and sustainability. He is part of the appeal panel for Single Resolution Board and the Joint Board of Appeal for the European Supervisory Authorities. David is also a legal expert for the IMF and a member of the UNIDRA drafting committee project on bank insolvency. David's presentation will focus on the regulatory risks and tackle the question, can climate change speak the language of risk? And the panel would not be complete without Ferdicia Snag. Ferdicia is a partner at Cleary Gottlieb Steen and Hamilton. She specializes in financial services regulation in the UK and Europe. She has a wide range of experience advising banks and other financial institutions and regularly advises on a variety of financial services and regulatory issues. Ferdicia will focus on some of the risk mitigating strategies, explaining that to address climate litigation risk, banks should be thinking of key areas of potential exposure and putting in place appropriate mitigants such as adequate governance and policies, robust data to the extent possible, and stress testing. Now, a warm welcome to all our panelists once again, and let me please invite Marguerite to kick us off with the overview of climate litigation trends. Thank you, Marguerite.
Many thanks, Nate, and many thanks indeed for the opportunity to say a few words on the trends that we have observed in the field of climate and indeed also nature litigation, and to also explain a bit more how we might see these as relevant to the financial sector. And just at the outset, just to flag that the usual disclaimer applies to my remarks. So turning first to a brief introduction. What is climate litigation? Well, at this stage, I think we can very readily describe it as a worldwide phenomenon. The United Nations have defined it as those cases that raise material issues of law or fact relating to climate change mitigation, adaptation, or the science of climate change. In essence, what we've been seeing is that activists are increasingly turning to the courts to seek to address the urgency of climate action. And we saw quite a significant increase in the number of cases brought since the Paris Agreement was concluded in 2015. About 1,800 cases, or 70% of the cases listed on the database by the Sabine Centre for Climate Change, 1,800 have been recorded since 2015. So as a result of this massive increase in litigation, it's been identified that these cases can be increasingly relevant, not only for the broader economy, but also for the work of central banks, supervisors, and indeed the financial system and banks more specifically. And this has been identified in a number of reports produced by the Network for Greening the Financial System. This network, in case you're not familiar, was founded in 2017. It's a voluntary grouping of central banks and supervisors from across the world that has come together to share expertise and best practices on the matter of climate and environmental risk and on adjusting the economy towards the net zero transition. It currently has 142 member institutions from across 90 jurisdictions. And the NGFS has two key, subgroups that have looked into the topic of climate litigation. The Experts Network on Legal Issues has now produced 3 reports outlining these trends and their relevance to the financial sector. And the NGFS Workstream on Supervision has looked more specifically at how these trends need to be considered in the context of microprudential supervision. So turning now to say a few words about these trends. And the first trend that maybe is worth presenting is the trend in litigation being brought against states and public entities. The most obvious and the most prominent aspect of this trend is so-called systemic climate litigation. And systemic climate litigation refers to those climate-aligned cases that are being brought against governments that challenge the overall effort of a state or its organs to mitigate or adapt to climate change. And there, of course, especially in Europe, we've seen quite a number of cases with over 20 before national courts, 1 before the Court of Justice of the European Union, and 7 before the European Court of Human Rights. The flagship case there was obviously the Urgenda case in the Netherlands, where the Dutch state was successfully challenged before the Dutch Supreme Court, which found that the greenhouse gas emission reduction targets and the plans for climate mitigation efforts on the part of the Dutch state were insufficient, and the Dutch state would have to adapt and take more ambitious action. The success in the Urgenda case was then replicated across a number of other jurisdictions, with the Neubauer case in Germany, with cases in France, in Belgium, in Ireland, and of course more recently also before the European Court of Human Rights in the case brought against Switzerland. Of course, systemic climate litigation is not the only way that states and public entities may be challenged. We're seeing also an increasing number of cases being taken against states arising from their licensing or investment in third-party activities. Cases brought on the basis of the procedural obligations, where litigants are relying on provisions requiring access to information on environmental matters or public participation in decision making. And then, of course, also central banks and supervisors have been directly targeted in certain cases, including the National Bank of Belgium arising from its participation in the Eurosystem's corporate sector purchase programme, and the UK's Financial Conduct Authority arising from its approval of the prospectus of an oil and gas company. You might then ask, well, how might this really be relevant for the financial system or banks more specifically? At first sight, it might not be obvious, but once you look a little bit closer, it's a bit more evident why this might be relevant. First and foremost, especially systemic climate litigation cases can lead to an increase in transition risks. Where a state is successfully challenged, it may be forced to rapidly pivot in its policies to take more ambitious state action to mitigate or adapt to climate change, with a knock-on impact for the economy. When it comes to challenges arising from licensing, construction and investment, this can lead to delays or the prevention of certain projects going ahead, the revocation of licenses or other permissions, and thus a knock-on impact on the companies that might be involved, who may suffer losses or may end up with stranded assets. Cases based on procedural obligations will inevitably increase the time and the costs associated with engaging in certain activities. And of course, perhaps most importantly, when we think of systemic climate litigation, we've got to understand that this can play a role in expanding judicial precedents to impose obligations not only on the public sector, but also on the private sector. And this leads me to my next slide, which is cases against companies and indeed also directly against financial institutions. Here we saw, as the trend started to develop, that in the beginning litigants were focusing on bringing actions against fossil fuel companies and energy companies. But as more and more successful precedents were identified, they expanded their types of defendants they were targeting to look also at companies in the transport sector, the agriculture and food sector, plastics producers, concrete producers, and even now financial institutions directly. And these litigants have relied on a number of different, very creative ways to identify legal basis to bring their claims. Tort law is an obvious type of legal basis, such as actions for damages and actions arising from an alleged duty of care. But these claims can sometimes be rather difficult to bring due to issues with the need to establish causation. Thus, litigants have been looking at other ways to bring such actions, including by relying on new corporate sustainability due diligence legislation, especially the duty of vigilance law in France. Litigants have also sought to purchase shares in companies with a view to then bringing an action against the board of directors of that company, alleging that those directors are breaching their fiduciary duties by failing to adapt the operations of the company to the climate transition. And finally, actions are increasing in the field of greenwashing, where companies are being challenged based on their allegations that they have made false, misleading or exaggerated claims relating to their climate performance. And what's particularly interesting here is the unique role being played by NGOs as plaintiffs in expanding the traditional understanding of litigation risks faced by companies and by financial institutions. NGOs are unique in that they're not driven by the financial aspects of bringing the claim. They are much less likely to agree to an out-of-court settlement or in-camera arbitration. Rather, their focus is on bringing strategic litigation with a view to influencing public policy through publicity. And in a way, they're not always very focused on whether or not the claim is successful, but rather on the very bringing of the claim itself in order to raise awareness of the issue. And that leads me then to say a few words about the potential relevance and impact of this type of litigation for companies and financial institutions. Obviously, if you have a successful claim, it's going to have some direct financial impacts, especially in terms of legal costs, in terms of damages and fines, and of course in terms of adaptation and compliance costs for the company involved. However, litigation does not need to be successful for some of these costs to materialise, especially when you think of legal and administrative costs associated with defending the claim, when you look at things like the impact that the claim may have on the value of the firm, its creditworthiness and its financing costs. The impact on the share or stock price of the company may arise already at the time when the claim is first brought. And of course, inevitably, you will have significant reputational costs. There can also be implications for the availability and the cost of insurance. And all of these need to be taken into account in the context of prudential supervision, where the work of the NGFS has highlighted that climate litigation can be considered a driver of other prudential risk categories, a driver of risks such as credit risk if a company to which the bank lends is challenged, operational risk for the bank involved, etc. And of course, last but not least, it's worth noting that the trend in climate litigation is not stopping at the topic of greenhouse gas emissions. We've seen that following the success of a wide range of climate litigation, litigants are using those successes to look towards also taking so-called nature-related litigation. So strategic claims which are focusing on other topics such as biodiversity loss and the degradation of ecosystem services. They're looking at challenging companies and states as well regarding issues such as deforestation, the degradation of carbon sinks, plastics pollution, and the loss of ocean habitats. And again, here we can see that litigants are looking at a wide variety of legal bases on which to bring their claims, including corporate due diligence, tort law, shareholder rights, and indeed also anti-money laundering legislation. The drivers of nature litigation, as I mentioned, are of course learning lessons from climate litigation, but also an increased understanding and appreciation on the part of litigants of the importance of the climate-nature nexus. On the one hand, climate change is exacerbating the degradation of nature, and vice versa, the degradation of nature is limiting the ability to adapt to and mitigate the worst effects of climate change. Both climate and nature litigation are also being driven by the fact that courts are much more willing now to engage with advanced scientific concepts such as planetary boundaries and earth system sciences. And finally, of course, it's interesting to note that there's a very close nexus between legislation and litigation, where new legislation is offering new grounds for future litigation, where litigation is trying to fill gaps where legislation does not yet exist or if it's weakly enforced. And of course, litigation is also acting as a driver for new legislation with a knock-on impact on the companies and indeed the financial institutions involved. So with that, I suppose a brief word of conclusion is that the trends are very much live. They continue to develop, and it's something that both central banks, supervisors, and indeed the financial sector need to keep a close eye on going forward. Many thanks.
Many thanks, Margaret. It was a very, very comprehensive and clear presentation. And now I would like to invite David for a presentation on regulatory risks. David, the floor is yours.
Thank you very much, Nate. Thank you very much for the excellent organization of this event. Thank you very much to Claudia Collins and the EBI team for the impeccable preparation. And thanks very much to Ferdicia and to Marguerite for sharing this panel. One of the advantages of speaking after Marguerite is that there's a lot I can spare saying. The challenge is whether I have anything interesting to say at all after her presentation. I'll just try. This is the question. I mean, because I think that to understand the implications of climate litigation, one has to take a step back and look at this as part of the phenomenon of climate change and its assimilation by bank prudential regulation. The key question is whether climate change can speak risk, because that is the language of bank regulation. And the clear answer is yes, fluently. This comes from the NGFS diagrams. One can see the different sources of climate risk. One can see the economic transmission channels, both micro and macro. And one can see the materialization of this in the different types of financial risk. One can see that legal liability from failure to mitigate or adapt is already identified as one of the economic transmission channels. But to go even further, climate litigation risk can also speak the language of risk fluently. This is an extract from Mark Carney's very famous speech, Tragedy of the Horizon, and already almost 10 years ago, he identified liability risk as one of the main drivers of climate change risks into the realm of financial stability and, of course, including risk. The words that are highlighted here are just to illustrate that even Mark Carney could not fathom the impact that climate litigation would have, because he's thinking about a scenario where climate litigation comes after physical risks have materialized, whereas where we are seeing now, as Marguerite very well illustrated, is a wave of litigation lawsuits that anticipate the risks that are being created. Now, the fact that climate change and climate litigation speaks the language of risk doesn't mean that the translation is perfect. There are elements related to climate risk that are not entirely captured by the framework of prudential regulation, related to complexity, uncertainty, the policy and political dimension, and social norms. So how do these can we provide some concrete examples? Well, first of all, climate risk is characterized as complex, meaning that the aggregate interaction of different components has a result that may not be anticipated by the study of each separate component individually, giving rise to contagion, feedback loops, etc. What does the bank prudential framework offer? A very analytical approach where different risks are classified, categorized, and put into separate compartments. So somehow there is a little bit of tension between these two conceptual frameworks. Second, climate risk is uncertain. There is no clear probability distribution of the shocks, and normally the time horizon are also long, whereas the models that generally characterize bank prudential regulation provide estimates for probability of defaults, and then they tend to work with relatively short time horizons. Climate risk is unfortunately politically controversial, so sometimes we cannot seem to let scientists speak their language, and we want to, introduce the political dimension into this. And thus, this creates a bit of reluctance in the prudential framework because it wants to be perceived as purely technical and not political. And finally, climate risk is shaped by the advancement of knowledge in climate science and therefore scientists, whereas bank prudential frameworks are shaped by risk analysts, prudential supervisors, and central bankers, also a very enlightened but a different social groups with a very different training and culture, if you will. So the question is, do these tensions apply in the case of litigation risk? And I think the answer, as Marguerite already anticipated, is yes. We can see this element of complexity in climate litigation. Why is that? Because courts reason by analogy. They tend to apply a persuasive line of reasoning in one case into a case that may be entirely different as to the facts and the legal framework. That's because the law is an interpretative construct, and sometimes open textured legal provisions like fundamental rights or general provisions on tort liability have a similar wording and therefore can be interpreted similarly. And therefore, cases like Urgenda against governments may impact other cases like Klima Senioring in the European Court of Human Rights. Lawsuits against governments can inspire lawsuits against companies like Milieu Defensive versus Shell, greenwashing claims like the claim against KLM, duty of vigilance in supply chains like Friends of the Earth versus Total, and may also inspire lawsuits against banks. So Milieu Defensive versus Shell has clearly inspired the grounds of the complaint in the case of Milieu Defensive versus ING, for example. So the fact that this is the case, because courts reason by analogy, should invite us to look at climate litigation as a complex phenomenon, where different nodes interrelate as part of a more complex network. Now, when we look at this from the perspective of bank prudential regulation, there is a little bit of a challenge to fit this complex phenomenon into the very analytical and compartmentalized vision that the Basel framework tries to foster in order to ensure legal certainty. Pillar 1 provides the main component is credit risk, but somehow the currently climate litigation does not show in the models to estimate probability of default or loss given default. It is very hard for this to be accurately estimated. Market risk, there has been a little bit of advancement in this direction, but somehow the way to channel this can be by way of operational risk and reputational risk, as this seems to be like a broader entity-wide point of entry for this. But it is an imperfect way of assimilation, and this is the main point. Pillar 2, of course, now within the European Union, there are legal provisions that enable bank supervisors to look into this aspect with regard to the riskiness of a bank's business model, but mainly it is the point of entry is the governance of the financial institution. Does it have the structures to adequately assimilate risk, process risk, anticipate risk? And this is compounded by the supervisory review. So currently, Pillar 2 seems to be the lever that bank supervisors are using to nudge the internal structures of banks into processing better litigation risk and therefore translating it into Pillar 1 measures. That is at least one possibility, but like I said, is an imperfect possibility. Another avenue is by using Pillar 3 disclosures and having investors add pressure to banks to do something about it. In terms of uncertainty, this is also present in climate litigation risk. One day, one has a case like Milieu Defensive versus Royal Dutch Shell, and then a few years later, the Court of Appeals announced the decision, but at the same time acknowledges that there is a duty of care. So it is unclear what companies are supposed to do with that. It is unclear how companies should interpret causation standards or duty of care standards in this context, especially where, like Marguerite said, the plaintiffs, NGOs are mostly not there by the money. They are focusing on systemic change in how companies process risk. One key question here, in order to process this uncertainty, is who has the burden of proving what, which is a matter that has not been settled by the courts. This also is influenced by politics, because at the end of the day, climate change is scientific, but concepts like burden of proof, causation, duty of care are shaped by perceptions of what is technical and what is political, as one can see in the diverging views in different jurisdictions. However, the answer to this is that bank regulation and supervision is supposed to focus not on probable losses, but in unlikely losses. And these losses should form part of what supervisors as well as financial institutions process. One paradox of this politically tense climate is that an increase in political controversy can make risks more acute, but also authorities less likely to act. And we can all think about climate skeptics, governments, and what impact this may have on climate risk. So ultimately, and with this I finish, we can see that throughout these technical debates, there is a very strong role for social norms. So the behavioral expectations of prudential supervisors and of banks, so what they expect that how other parties will behave, and normative expectations, what they expect how other entities should behave. This is, in reality, what influences the debate, because the economic estimates are there, the risk is clear and present, but the debate is about the apportionment of those losses and the pathway to incorporate them into decision-making models. So in institutions that, like prudential supervisors, tend to think that their models, based on, you could say, imperfect, historically based time horizons, is the only scientific way to think about this, then change takes time. And this would be what an expert in social norms dynamics would tell us. Thank you very much.
Thank you very much, David, for this multi-layered presentation on regulatory risks. It was really, really interesting to listen to your discussion here. So now we've seen what the climate litigation trends are, what the regulatory risks are, and now we're moving into the realm of risk mitigation strategies. And here I would like to invite Ferdisha to provide some of her views in this very important area. Thank you, Ferdisha.
Thank you very much, Nathan, and thank you to the EBI for organizing this webinar. David and Marguerite, very interesting presentations. It's been very fascinating to hear from you and to view your presentations. And I think the overarching theme of our discussions is uncertainty. So I'll pick that word from David's sort of lost in translation slide. And so I want to talk more about this uncertainty from a practical regulatory standpoint and what financial institutions should think about in managing the uncertainty, again, from a practical standpoint. And the short answer, in my view, is that yes, these are very complex issues, but firms can achieve a lot by covering the basics. So what I have to say is not at all technical. David in particular covered that ground really, really well, but entirely, you might even say common sense. The fact is that a lot of the uncertainty today is being driven by the changing regulatory environment. So shifting ESG expectations and political pushback against ESG in some places at the same time as you are seeing new compliance frameworks around disclosure and reporting and diligence, etc., in other places. So over here in Europe, we may think there is complete consensus on the direction of travel as we've been kind of seeing it in the past few years since the Paris Agreement. But now, for example, in the US, things seem, especially now with the change in administration, to maybe pull banks in the opposite direction from where we've been going over here in Europe. But I would say that amidst this flux, there are two fundamental sort of premises, two fundamental principles to all of this. Firstly is that climate litigation is not new and is not going away. So from a historical perspective, this has existed for decades. And despite evolving trends, as we've heard, it has consistently expanded in scope, covering more jurisdictions, more industries, and more types of claims, again, as we've heard, especially from Marguerite. And the other sort of fundamental principle, I think, is that climate policy may shift, as we're sort of experiencing now, but climate science is not necessarily shifting in the same way. So regardless of political perspectives, we cannot ignore the physical risks, the increasing frequency and severity of wildfires, extreme rainfall and flash flooding, hurricanes. So I come from a part of the world that is very vulnerable to hurricanes, and every hurricane season, the storms seem to be getting stronger and stronger. And then in other places, you have prolonged droughts. These environmental catastrophes create real financial risks, and they will continue to drive litigation as affected communities, businesses, and regulators seek some sort of redress. So with that in mind, what do I and my colleagues at Clarke Gottlieb think of when advising on how to navigate this landscape and mitigate financial firms' exposure to climate litigation risk? First step, I think, is just understanding where the exposure is and what is at stake. So the point here is that as a financial firm, you are increasingly in the crosshairs of climate-related lawsuits. Why? Because you are seen as having deep pockets and playing a critical role in financing in the industries that are sort of carbon intensive and linked to climate change. So as a firm, I would say first thing is to get familiar with the ways you can be sued or otherwise have some sort of liability from litigation in this space. So, I mean, we've talked about the types of lawsuits we've seen, lawsuits that are like we've seen specifically targeting banks. They can take kind of several forms. So we've seen already, the misrepresentation lawsuits, including in the enforcement context as well. So not necessarily just sort of private litigation, but also regulatory greenwashing enforcement action. Failure to disclose climate risks, so inadequate, transparency about your exposure, etc., including the exposures through financing. And then claims for financing high emission industries. And as I said, these things are no longer hypothetical. We are actually seeing them. And the consequences, go far beyond legal costs. Litigation, can damage a bank's reputation, share price, and financing costs. And in an extreme cases, you can end up with stranded assets. So once you get to grips with this, I think, and I said, what is at stake, then a lot of it will be applying the basic principles of risk mitigation, tailored, of course, to this particular issue. So first and foremost, ensuring that climate litigation risk is embedded into governance structures and decision-making processes. And that is even in the face of shifting regulatory policy. So this means fundamentally that senior management and boards have to be engaged. And in this space, the question of fiduciary duties and directors' fiduciary duties always comes up, and it can be a bit controversial. But I think wherever the legal position ends up, the point is that climate risk is a core financial and legal risk that has to be integrated into a bank's overall risk framework in some way or form. So establishing clear risk appetite frameworks and having the board drive that is probably the first principle of risk management. Then other things, ensuring that you do diligence on your borrowers and on your counterparties to work out, what is their emissions, what are their emissions data, what are their physical risks, what physical risks are they exposed to, do they have a credible transition plan? So you know what you're financing basically as a bank. And then focusing really on climate disclosures. So, some regulators and investors, and I think in this environment, we have to qualify to this, some are demanding greater transparency from banks on your climate-related risks and commitments. But of course, as we've already heard from Marguerite, with greater transparency, there is a risk of misstatement, inaccuracy, exaggerated claims that can lead to litigation. So here there are there's a lot of work already done on disclosure. So frameworks like the TCFD, the Task Force on Climate-Related Financial Disclosures, and the ISSB, the International Sustainability Standards Board. A lot of work and thought and input has gone into that, and those frameworks have been subject to a lot of refinement over time. So I would say that is the starting point in thinking about disclosures in this space. But of course, you have to be aware of and meet your actual obligations. As there are newly enforceable regimes like in Europe, the CSRD framework, the Corporate Sustainability Reporting Directive framework, that could also be the basis of litigation and enforcement. Stress testing and scenario analysis. So this is something that over here in the UK, the Bank of England in its 2021 sort of climate stress test, or the climate biennial exploratory scenario, that was something that was highlighted in that process. And the Bank of England actually asked general insurers to quantify the potential losses from climate litigation risk against some hypothetical scenarios. Banks can do a similar thing to try and quantify the exposure as well by identifying vulnerabilities in loan and investment portfolios, assessing the financial impact of different climate-related legal outcomes, and developing sort of preemptive risk management strategies to mitigate exposure. And then I think the final point I want to make is that navigating the transition risk landscape is probably the most sort of unique and but also growing a source of climate litigation risk. So we are seeing this backlash against ESG policies in some jurisdictions. So that adds to the complexity. So you might be between a rock and a hard place, in that there might be some alleging that you're not doing enough. There might be others alleging that you're doing too much. I think just understanding that and remaining adaptable, engaging as well with regulators and policymakers as well, and having sort of realistic, data-driven ambition, I think, that you can justify, is a key aspect of mitigating that. So that's as I said, those are to my mind the basic tenets of risk mitigation. This is how you would mitigate risk in all sorts of areas. But if you put the climate litigation lens against those issues, I think as I said, I don't think a financial institution can go very far wrong in kind of looking at things through that starting point.
Thank you. Thanks, Verdusha. You said basic, but still critical. Critical, looking at it with the aggregate perspective in mind always. Yeah, many thanks for all your presentations. Now, I would like to move to the next stage of our webinar, which would be myself asking you some very, very tricky questions, that would stimulate additional thought further that you have introduced. But why don't we start with you, Marguerite? You said that we've seen a few significant court outcomes. I think your presentation included quite a few. But for instance, the ruling of the Hague Court of Appeal in Milieu Defensif v. Shell, along with plenty of anti-ESG litigation in the US. Could you please explain some more how climate litigation trends may develop in the future, now that we have taken stock of the events and analyzing those looking backwards? Thank you.
Certainly, with pleasure. So indeed, the Shell ruling that came out on the 12th of November, which was also mentioned by David, is very interesting in that it overturned the ruling of the lower court that set a very clear requirement on Shell to reduce its greenhouse gas emissions by 45% by 2030. And many have said, oh, well, maybe this is the end of the trend in climate litigation. You know, this was in a way a setback because it removes this 45% very clear requirement as a result of the ruling. But I think that might be a bit misleading because at the end of the day, the court very much emphasised that Shell does have a duty of care. It upheld I suppose, the fact that the agenda is setting out obligations not only on the public sector but also on the private sector. And so Shell must reduce its emissions, and also it needs to look very carefully at its further oil and gas investments, which may be at odds with this duty of care that arises from the Dutch law. What the court said it couldn't do is to specify the percentage of what that reduction should be. And in a way, that's quite legitimate, given that at the end of the day, that's something maybe more reasonable for a legislator to do for when you think of the separation of powers. And there also, I don't think that particular ruling is the end of the story, because the NGO, as far as we understand, will be appealing the ruling of that court to the Dutch Supreme Court, which of course, as we know, was the same court that made the final ruling in your agenda. So I think we need to be very careful about not concluding that this is such a major setback for climate litigation overall, and also to be very aware, of course, that the same litigants are planning to try and bring a case against ING and to try and test the waters against a bank using the same argumentation arising from the Dutch tort law duty of care. So that's one aspect to think about. The second is, of course, that it's true you've mentioned that there's significant anti-ESG litigation, but in a way that has always been priced into the cost of doing business. And indeed, for example, anti-ESG litigation, if you want to call it that, in the EU has been around a long time. The emissions trading scheme has been challenged on in a number of cases before the Court of Justice. So that's, I suppose, already part of the landscape. What's new and what's growing is the trend in climate litigation being brought by NGOs. Finally, just to mention, I suppose, what's more worrying here is that we're seeing that physical risks are becoming much more evident, that the damages caused by, for example, the LA wildfires are a very obvious result of climate change and are being seen as such by the people who are suffering the damage. And in the US especially, I think we can begin to see more and more of the loss and damage cases. We've seen, for example, proposed legislation in California that would allow victims of natural disasters to sue oil and gas companies to get damages for those detrimental impacts. And the state of California, for example, along with other democratic states, are bringing cases themselves against oil companies for damage and for misleading the public as regards to the impacts of their products. So yeah, overall, I think, it goes without saying that the trend will continue. It may start to take different forms, but I don't think there's likely to be a slowdown in the development of the trend going forward.
I see. Yeah, thank you very much, Marguerite. I would like to move now to David. David, you have mentioned already in your presentation the important role that the courts have in this particular environment, obviously. And, there are no unknown actors. They have been there for some time. And so why talk about litigation risk in particular here? Like, does climate litigation present any particular problems here?
Yes, that's the answer, Nate. And if I may elaborate, our traditional understanding of the role of courts and litigation is that litigation is bipolar. So there's one party that says A, one party that says B, and it's either A or B. It's retrospective, so it looks at the past behavior of the parties. It's the right and remedy are interdependent. The ultimate goal is to obtain compensation, most likely. The lawsuit is self-contained, so it's a very specific set of facts. And this has nothing to do with climate litigation. Climate litigation is no longer bipolar. There's a multiplicity of factors and possibilities. It's not retrospective. It looks to the future. Right and remedy are not necessarily interdependent, because the plaintiffs do not seek compensation. They seek change. And therefore, the litigation is no longer a self-contained episode. I think that the closest analogy is a conversation. Litigation is conversation, I would call it. And that's why the role of courts, courts adopt a role that is not that comfortable for them, but at the same time, it is also uncomfortable for the parties. So naturally, this wouldn't be, of course, an issue if governments were somehow adopting transition pathways that were aligned with Paris, and therefore companies had legal certainty to adjust to those pathways, of course. But an important aspect is that this is a source of uncertainty because it's uncharted territory, starting with the courts themselves.
And David, if we expand on this a little bit, like what features of litigation make it particularly problematic for transition risk? Could you maybe expand on that?
Yes, absolutely. So transition requires certainty. It's one of the things that usually companies insist upon. If we have official pathways, we know what to do. So the more uncertainty, the greater the risk. And in this sense, either in those cases where there are no official pathways, or in those cases where there are multiple voices, so like climate-aligned litigation and climate-not-aligned litigation, that increases uncertainty, and that makes it likelier that the transition will be a disorderly one, as the NGFS says. So in that sense, I would say that in those countries where there is a lot of polarization, in principle, transition risk is likely to be higher, not lower.
Indeed. Okay. Yeah. Thank you. Thank you very much, David. And I would like to also ask Ferdisha a question to expand a little bit on the presentation with the mitigation that you have put forth. So with climate litigation risk remaining complex to evaluate, I think that is very clear by now. How should banks read the tea leaves, so to say? What should they be doing, and what should they be focusing on in particular? Just drawing back on your presentation.
Thank you, Nate, and indeed, the strategic and financial impact of climate litigation remains very difficult and complex to measure. But the bottom line is, I think that's all of our kind of presentations have brought that home, is that it could be significant for banks. And so what I have taken away from hearing everyone is that as both an amplifier of risk and also a distinct avenue of climate risk, litigation presents a very unique sort of set of issues, and the regulatory landscape compounds that. So to that question, I think I just want to reiterate actually my remarks at the start. Climate litigation risk is here to stay precisely because of the uncertainty. So the legal and regulatory landscape will continue to evolve, but the risks, both the physical risks, the financial risks are undeniable, despite political perspective. So how do you mitigate? Well, you prepare and you think through and you base your strategy on the risks, and you come up with something that's feasible based on the data that you have or that you should have. So, having a sort of robust framework for collecting data is important. You come up with something that you can actually use and defend. So as I said, to my mind, it's very basic. And so to sum up, kind of what I said earlier, and what I think the path forward requires, is the strong and robust governance, actual leadership and oversight to ensure that these risks are recognized at the highest levels. It's the enhanced due diligence, the transparent and accurate disclosures, the stress testing, the scenario planning, and a proactive approach to transition risk management, which, as I said, is really what is unique and what is uniquely driving this in a rapidly shifting regulatory environment.
Okay, thank you. Thank you very much, Ferdisha. Now, I could certainly go on and ask a few more questions. I'm really curious when I have such a knowledgeable and experienced panel in front of me, but as we mentioned early, at the beginning of the webinar, we're opening up the floor to the audience also to pose some questions to our panelists. And I have seen in the chat that René Smits has already a question for Marguerite, and asking if Marguerite could elaborate how the AML legislation can be a tool in nature-related litigation. Marguerite, if you would like to address this, please feel free.
Certainly.
The floor is yours.
This is a very interesting case. It was and I can maybe the easiest way is just for me to explain the case that has already been brought. It's been initiated, but we don't have any recent information as to how that case has progressed. So it was a case brought by an NGO to the French public prosecutor, where it alleged that 4 French banks were engaged in anti-money laundering as a result of their financing of cattle companies in Brazil. So the arguments that they're putting forward is that significant investment have been made by these banks in these cattle companies. However, at the same time, the cattle companies have been engaged in alleged deforestation in the Amazon and encroachment upon the rights and the lands of indigenous people. So in a way, engaged in quite significant legal activity. And by purchasing or by holding the bonds of these cattle companies, in a way, the banks are legitimizing or I suppose, laundering the money, the profits from these companies, because once the bonds are repaid, then it makes its way into the financial system in a more legitimate manner for the companies involved. So that's the allegation. It was a case that was brought to the public prosecutor in the end of 2023. We haven't heard any updates recently, but it was a very interesting strategy to look towards anti-money laundering legislation and the way that can be used to try and address issues with deforestation in completely other parts of the globe.
Thank you, Marguerite. It seems like René may have asked you this question before already, given your, given your response and accuracy in it. But thanks a lot. I see another question from audience. This is from Professor Georg Ringe, and he's asking a general question. Is climate litigation the appropriate strategy in your view? Or should these issues better be addressed by democratic lawmakers? Georg did not extend this question to anyone in particular, but if there's anyone who would like to address, please feel free.
If I may, because I think somehow it's implied in one of the things I said before. The answer is yes. But the second part of the answer is they are not doing it. So we are no longer in weighing optimal solutions. So we are deciding which of the suboptimal solutions is less suboptimal. And I guess that's what explains the reaction of some courts. So some courts, I mean, the position of certain courts maybe is controversial, is going to remain politically controversial. But it is also going to be controversial if they decide to not rule on the issue. So it's going to be part of the controversy either way. And as long as there are no official pathways and governments do not provide clarity as to what is the behavior that companies are supposed to abide by, then this will keep on feeding the stack of cases in courts' desks. So yes, the answer for governments, if they want to reduce litigation risk and reduce all this uncertainty, is to create certainty themselves. But one can see that somehow this is filling a void of uncertainty. And I guess that this is what the 3 panelists have been discussing today.
Many thanks, David. And I'm looking at the time, but we still have a few questions within our chat. I would like to read one more. This one is from Tiffany, and she's asking, do the panelists think that banks and companies will be subject to more litigation risk because of what they disclose in climate transition plans? And if so, any advice on how to mitigate this? Would anyone be willing to respond, Tiffany?
I think it continues to kind of what I was saying. So yes, yes. I think this transition plan and disclosures generally are a key source of all sorts of risk in this area for banks. And I think for banks, I said you have two things to weigh up, right? You can kind of maybe not say enough and not do enough, or say too much, or not do or not or do do too much, basically. And you could have claimants alleging one or the other, and so you're sort of caught in a difficult position. But ultimately, to sort of mitigate that risk, I think accuracy. So having something that is not just something that you just say for the sake of it, but it's actually based on science, based on data, is measurable. So if you put a target in there, you can actually kind of verify that. It takes into account your entire business. So all aspects of your financing, of your internal book, etc. But it's about being thoughtful about this, about being careful about this, and just realizing what's at stake.
Thank you for this, and I see David has raised his hand as well. Please go ahead, David.
I think that the answer was very good. I just have to add, yes, higher short term, lower long term. That's the way I see it. So initially, as you feed in the market with more information about your internal processes, this gives more material to plaintiffs to sue you. But at the end of the day, as you disclose more information, as that information is based on science, and as courts start pronouncing themselves and saying that a science-based, credible transition plan makes a firm, confident that there's nothing to be afraid of, then that may eventually drop the level of litigation risk in the medium to long run. I think at least that is what the regulators are trying to do, and the only potential risk here is that courts start making mistakes. But I think that given the complexity of the information contained in transition plans, better transition plans should reduce litigation risk in the long run.
Thank you very much, David. We still have questions in the chat, but unfortunately, I think we ran out of time. This was a very, very interesting webinar, and I really hope that you have enjoyed this installment of the EBI Policy Series. And again, I would like to thank our guest speakers for a very intriguing discussion, and as well to my colleagues at the EBI who have worked hard to organize this event. We'd like to thank everyone for tuning in, for your attention, and we certainly hope to see you back soon. Thank you very much.